Good morning, students. Welcome back to this session on advanced accounting. So as we've been discussing consolidation, so today we plan to continue with our discussion on the consolidation. In terms of consolidation, we have discussed about the consolidation requirements for subsidiaries, wherein the line-by-line addition is required. In the previous session, we also started the discussion around the consolidation of joint ventures, wherein we discussed that when it comes to joint ventures, so there are three types: jointly controlled operations, jointly controlled assets, and jointly controlled entities. So today we plan to continue with our discussion in relation to JVs, and we also plan to cover the consolidation requirements for associates. Okay, so that is going to be the agenda for today. All right, so now jointly controlled operations, we discussed that this is again a kind of arrangement or a kind of JV. But in case of jointly controlled operations, a separate entity is not created. Okay, so it's a kind of setup, or you can say collaboration, wherein two or more partners will come up. They will enter into a project and they will start pooling their resources, assets, and all of these stuff together so that that particular project can be carried forward. Yeah. And in respect of jointly controlled operations, we also discussed as to how its accounting will be done by that particular venture, or you can say by that particular kind of operation which will be going on between the JV partners, and how all of these things will get recorded in the books of the JV partners. So that is about the venturer. Okay. So now we will move on to this next type of arrangement, or you can say next type of JV, which is jointly controlled assets. So now let's try to understand what is this jointly controlled asset. Okay, what is this arrangement? Now, in case of jointly controlled assets, once again, it's a kind of JV. So that means once again, we will have two venturers or more than two venturers who will come together. They will enter into a project. Okay. Somewhat you can say similar to what happens in case of jointly controlled operations. Okay. And they will also not create a separate legal entity. Again, they will not be creating a separate legal entity. So this separate legal entity is not created here again. But in this case, venturer owns the assets. Assets means the assets which are going to be used in relation to that particular project, in relation to that particular venture, will own those assets jointly. Okay. If it comes to any expenses which are in relation to that particular JV, if there are any liabilities which are taken up as a part of this project which will be going on, okay, so now all of those expenses, all of those liabilities, they will be shared amongst the joint venturers. Okay, so that means the venturers. So now there are some features similar to what we discussed in case of jointly controlled operations. So let's try to understand about some of these points, and then we'll pick up one example, because I think that some of these points can be understood with more clarity once we get on to that practical example. Okay. Now, in case of jointly controlled assets, there is no separate legal entity. Okay. But there is a common control over the joint assets. So what do you mean by this? That the assets in relation to that particular JV will be jointly owned. Venturers will use these assets to derive some economic benefits. Of course, that is why this JV will come into the picture. Each venturer incurs separate expenses for their transactions. Expenses on jointly held assets are shared by the venturers. So if there are some common expenses, so how do you deal with them? They will be shared, and this sharing ratio will be pre-decided, because once again, because it's a JV, so that's why JV will have to have a contractual arrangement to get into existence. Now, when it comes to the financial statements of the venturer, so what will the venturer do? Venturer will show only their share of assets and the total income which is earned by them, along with any expenses which are incurred, okay, in relation to those assets. Now, since the assets, liabilities, income, expenses are already recognized in the separate financial statements of the venturer, they will move on to the consolidated financial statements also. Why? Because when the venturer will record its shares, okay, when it comes to assets, liabilities, incomes, expenses in the standalone financial statements only. So what will happen? When the consolidated financial statements will be prepared, so from standalone, they will automatically move on to the consolidated financial statements. Again, you can say somewhat similar to what we discussed in case of jointly controlled operations. Financial statements may not be prepared for the JV. JV means that venture, that collaborated entity. Yeah, because it's not a separate legal entity. So of course, financial statements will not be amended, but only for the purposes of this share to be derived, amount to be looked at, their books of accounts or their financial statements may be prepared. Okay. Now, there are some differences, or you can say there are some similarities in between jointly controlled operations and jointly controlled assets. So what we can do is we can just quickly look at those similarities and the differences, and then we will move on to one example. Now, when it comes to a jointly controlled operations, venturers use their own assets for the JV business. But in case of jointly controlled assets, they own the assets over which ownership will be joint. Okay, so you can say maybe there is a machine. Okay, so this is one single machine. So that has been contributed to the JV business. Now, in relation to this single machine, what will happen? The ownership of this machine will be joint, means it will be jointly owned. So it will be 50-50 or 45-55, whatever be the case. Okay. So in case of JCA, as when it comes to JCO, jointly controlled operations, it's an arrangement to jointly carry out the operations to earn income. Whereas when it comes to jointly controlled assets, it's an arrangement to jointly construct and maintain an asset to generate revenue to each venture. Third, under jointly controlled operations, all the expenses and revenues are shared at an agreed ratio. But in case of jointly controlled assets, only expenses which are incurred in relation to those jointly controlled assets, they are shared. Okay. Otherwise, anything else that will be absolutely belonging to that particular joint venture. Okay. Now, we'll look at one example, and with the help of that example, we'll get more clarity. And in between, I can see some of the queries coming in. Just a minute. If you have any questions, doubts in between, please feel free. Okay. And let me just move on to one example now. All right. So now Srinivasan has a query. Srinivasan is asking, sir, in jointly controlled operations, who controls the assets? See, in jointly controlled operations, I think we just discussed this. Each venturer will own its assets. So let's suppose there are two parties, okay, A and B. So A will bring in his assets, B will bring in his assets. So that's how it works. Okay. So let's look at this example. ABC Limited, BP Limited, and HP Limited having the same point of oil refinery and same place of customers agreed to spread a pipeline from their unit to the customer's place jointly. So there are three companies. They are into the business of oil refinery and their customers are common. Okay, so that's why what do they need? They need pipeline. Okay, so when they will extract oil or they will refine oil, so this oil is required to be moved to the locations of the customer. And because the customers are common, so that's why what do? They set up this pipeline. You can say it's a huge infrastructure which is in the form of an asset, and this infrastructure is set up by them in a collaboration manner. Okay, so because of which what will happen? Now they will have this infrastructure, or you can say pipeline, which has been set up. Now this pipeline is being set up by three partners. So that's why there will be a joint ownership over this infrastructure. Now they agree to share the expenditure on the pipeline construction. One, maintenance of the pipeline in a particular ratio. Okay, so ratio can be, as we discussed, not equal or maybe equal. Okay, it may vary, it doesn't matter. Time allotted to use the pipeline was again decided. Means if the pipeline will be used for supply of the oil, so they will decide the number of hours in a particular day, okay, as to how it will be used. So that is all about usage of the asset. Now in this case, each venturer, who are the venturer? Can you tell me the name of the venturer in this case? Over to you. In this case, each venturer will record his share of joint assets. But can you now tell me quickly who will be considered as the venturers? So can you tell me the name of the venturers in this particular example? Over to you quickly. Names of the venturers. Who do you think will be the venturers in this example? Yes, quickly. Waiting for a response now. All right. So Pratima is saying ABC, HP, and VP. Very good. Pooja has got the same answer. Okay, great. So now, every time whenever we have a question, please understand that venturer are the investors, or you can say they are the owners. So in this case, ABC, BP, HP, so they are the venturers. ABC, BP, HP. And what they have done is they have come together. They have come together and they have created a JV. And in this JV, one asset is set up. Okay, one asset is set up. What is that asset? Pipeline. Or you can say one infrastructure is set up. Now, this infrastructure which will be jointly owned by them. And what is going to be the purpose of this JV? To use this infrastructure. Or you can say to serve the business purpose using this particular infrastructure. Okay, so that is how we understand a jointly controlled asset. All right. Yeah. Clear on this? Any questions on this? Everyone, any questions on this? So now we'll pick up one example. Okay, wherein we discuss the accounting requirements in relation to this JV setup. So that is about jointly controlled assets. All right. So let's move on to this question. Any questions, any doubts in the meantime, if you have, please let me know. Yes, any questions? Any doubts? Any questions? Any doubts? Hope this is clear to everyone. Yeah. All right. So now let's look at this example. A Limited, B Limited, and C Limited. They decided to jointly construct a pipeline to transport the gas from one place to another that was manufactured by them. So once again, we have a similar sort of situation that there are three venturers. Who are those venturers? A Limited, B Limited, C Limited. Okay. And they have constructed a pipeline. So can you tell me which asset will be considered to be the jointly controlled asset in this example? Over to you. Which asset will be considered as the jointly controlled asset in this example? Yes, quickly. Kiran is saying pipeline. Okay. So now, for the purposes which they have specified, following expenditure was incurred by them. Building, rupees 12 lakhs, which will be depreciated at the rate 5% per annum. Pipeline, 60 lakhs, which will be depreciated at the rate 15% per annum. Computers and other electronics to be depreciated at the rate 40% per annum. And other vehicles of rupees 9 lakhs to be depreciated at the rate 20% per annum. Okay. So this is going to be the expenditure. So that means 1 building, 2 pipeline, 3 electronics, and 4th will be vehicles. Okay, so they are going to incur these 4 expenditures, or you can say they will be spending amounts on these 4 items. They also decided to equally bear the total expenditure incurred on the maintenance of the pipelines. Now, pipeline is something which will be required to be maintained. Okay, which will be 6 lakhs per annum. So what they have decided is that every year 2 lakh, or you can say an amount equivalent to 2 lakh will be borne by each venturer. So in this example, you are required to show consolidated balance sheet and the extract of statement of P&L and the extract of balance sheet of each venturer. Now, please remember that in this example, only the extract is required. Now, what do you mean by extract? Extract means the relevant portion of the statement of P&L, the relevant portion of the balance sheet. You are not required to draw this complete balance sheet, complete statement of P&L. Why? Because if you look at the information of the venturer, so in that case, complete information is not made available. Yeah, so if you were to prepare the financial statements, balance sheet, P&L of venturer, do you have complete information available? No. So that complete information is not available. So that's why you will not be able to prepare complete balance sheet or P&L. So that's why, don't worry, you will just need to go by the limited information, and that's why the statement of P&L and balance sheet that you will prepare will also be a small portion. Okay, it will not be a full set or the complete set. Yeah. So now moving further on to this. In this case, the first point that we need to look at will be the JV. Okay, so one JV is going to come up. Yeah, so one JV is going to come up in this example. So now when we talk about this JV, so this JV will of course have some assets. This JV will be incurring some expenses, and all of those assets and all of those expenses belong to whom? Various JV partners or the venturers. Correct? So that's why at the first place, what do we need to have? We need to have the balance sheet. We need to have the balance sheet of that particular JV. Okay, so let's move on to that particular balance sheet. So now balance sheet of that JV can always be prepared in full because we have the relevant information available in respect of that particular JV. Yeah. And please also look at the requirement of the question. Question specifies that the consolidated balance sheet is required. Now over here, question is not saying that you need to only prepare question is not saying that you only need to prepare the extract. So that means this much portion when it comes to the consolidation or the consolidated balance sheet, or you can say the balance sheet of the JV has to be in full. Okay, clear? So let's move on to the balance sheet. So now in the balance sheet, please remember there are going to be some items, 4 assets, yeah, expenses which are incurred. So we'll deal with them. Okay. So now, first of all, what you should do is you should, in a similar manner, like we have done in the previous examples, also in the previous sessions, draw the structure of the balance sheet. So we should have shareholders fund, share capital, then we should have PPE. Why? Because PPE was contributed. Then, of course, the notes to accounts will come in. Now, in respect of notes to accounts, now if we look at PPE, now PPE has been contributed in the form of 4 assets. In the form of 4 assets, correct? So what were those 4 assets? Land and building. Land and building. So now if you go back to this land and building, its value was what? 12 lakh. Land and building was 12 lakh. Okay. But you are required to prepare the balance sheet at the end of the year. Obviously, yeah. And for the year, depreciation will have to be charged. Okay. So that's why, do we consider 12 lakh? No, we don't consider 12 lakh. In example, what do we need to consider? We need to charge depreciation on this building. Similarly, we need to charge depreciation on plant and machinery. Now, if you go back to the plant and machinery, what was the plant and machinery? Pipeline. Okay, so this was the pipeline. So this costed 60 lakhs. Okay, so this is 12 lakhs less depreciation. Similarly, pipelines. Okay, so the gross block less depreciation. Okay, similarly for computers, now what do you do? For computers, we have 3 lakhs less depreciation. Vehicles, 9 lakhs less depreciation. Okay, so all of this information will place here. Yeah, so this is the net block, because in the balance sheet, what will happen? All of these net items will, correct? Yeah, so all of these net items will move. Now, at one place, what do we have? At one place, we have all of these assets. So if you take the total of these assets, so what will it become? So can you quickly compute the total of these assets? Can you quickly compute the total of these assets? So let me just also take the total. So this is 11,40,000 plus 51 lakh plus, what is the next item? We have 1,80,000 plus 7,20,000. Okay, so this becomes 71,40,000. Now this is the amount. Which will be contributed by the venturers. So this amount will be contributed by the venturers. Okay, I think Rashmi has computed this amount, 71,40,000. Now, if you look at the JV, in a JV, what will happen? At one place, funds will be required, because if these items are required to be purchased, so what will happen? All the venturers will contribute to the funds. Okay, so at one place, funds will come. Now, when the funds will come to the JV, what do you call it as? It's a capital contribution. It's a capital contribution by the venturers. So that's why what will you do? You will put this money in the form of capital contribution, or you can say the share capital. So at one place in the balance sheet, what do you have? Various assets. 1, 2, 3, 4. Okay. Why? Because only 4 assets have been contributed. So these 4 assets have been contributed at one place. Okay. And corresponding to these assets, this capital contribution will come. Okay. Which is nothing but the total of 1 plus 2 plus 3 plus 4. All right. Yeah. So this is how balance sheet of the joint venture will be prepared. Now, this information that we have discussed so far will now be moved to the main balance sheet, or you can say the face of the balance sheet, because all of these information that we discussed so far was in relation to the notes to accounts. So now 71,40,000 will go to the capital, and 71,40,000 will also go to the assets. And in respect of this JV, we have got only one category of assets. So that's why only that particular category will be specified. Okay. So now, once again, you may be thinking, but sir, this is a very small balance sheet. There are very few items in this balance sheet. So is it okay? Yes, of course. This is absolutely okay. Why? Because if the information is very limited and the line items are very limited, then of course you don't need to add something from your side. Huh? So absolutely okay. I can see one query coming in from Srinivasan. So I'll just take up this query and then we'll move on to the remaining part of the solution. Srinivasan is asking, sir, why joint venture account is not opened for jointly controlled assets case, and why the format of financial statements are different? So I think you need to just revisit this point, Srinivasan. If you look at the format of the financial statements, so there is nothing which is different. Format of the financial statements is absolutely same, the way it is required to be done in case of any other entity or any other venture. Okay, so that is one point to it. Your second query, that why the JV account is not opened. See, that will again be dependent on the requirement of the question. So if you are looking at the ledger account, okay, so the question doesn't require us to prepare the ledger. Question doesn't require us to pass the accounting entries or the journal entries. Okay, so we'll just go by the requirements of the question. In this particular question, information was very limited. Yes or no? Information was very limited. So why I'm saying very limited? Because only 4 items are there, and those are assets which are required to be placed in the balance sheet. Okay, so that's why we don't need any separate working, or you can say the accounting entries. Question also didn't specify that, but as a part of your solution, if you want to add a working note, you can always feel free to do that. Okay, so that is absolutely okay if you want to prepare. So I think you are looking at the working note. That's my understanding. So that is absolutely okay. But as far as the format is concerned, that is absolutely in line with any other format that you will have. Okay, Pratima has a query. Pratima is saying, sir, do we have to give how we got share capital as note, like we have computed it from the assets? Not necessary. Yeah, it's not necessary, because in this particular question, it's quite understood. But even if you want to add a note, so let's suppose in the exam, you are confused. Okay, you are confused that whether you should explain this or not. When you just give a note for this explanation, then there is absolutely no problem in doing that. Okay, because if you are giving a note, that doesn't mean you are doing something wrong. All right. See, if the question asks you for a note and you are not giving it, then we can say that it's something which is incomplete. If the question is not asking for anything, but you believe that you just want to add to your explanation, because of which you want to give a brief note, that is absolutely okay. But please don't write essays for that. Huh? That detailed explanations, commentaries, that you should avoid. All right. Now, Uni Krishnan has a, okay, Uni Krishnan is saying consolidated balance sheet prepared by whom? See, once again, if you look at this entire structure, in this structure, there are three parties, A, B, and C. So everything which is required to be done, I'm just talking about the administrative stuff. This will be done by these three partners only, or these three venturers. But when it comes to a JV, so what will happen? When they will create a JV, okay, so you can say this JV is nothing but a project which they will set up. Okay, generally this is called as a project. And for managing a project, they will always depute people, okay, who will be managing that particular project from administrative side at least. Yeah. So there will always be people. I'm just telling you the practical aspects to it. Now, because there will be people who will be managing this, who will be also keeping the records, books of accounts, okay, on a day-to-day basis, various expenses which will be incurred. So that's why what they will do is those people will also be preparing this consolidated balance sheet, or you can say the balance sheet or some of these records in relation to the venture or this JV which has been set up. So that is how it works. Okay. Then Kiran is asking how to compute the share capital. Very simple, Kiran. It's very simple. So in this case, 4 assets were contributed. Yes or no? Yeah. Building, pipeline, computer equipment, and the vehicles. So if you take the total of these 4, that is what is the amount of capital which is contributed by the venturers. Simple. And this is what I've done. 1, 2, 3, 4. If you take the total of these 4, you will get the capital contribution. Okay. So I'll move further now. Yeah. All right. So now what we need to do is, now we will need to get on to the books of each venturer. Now we'll need to get on to the books of each venturer. So we'll pick up the books of A Limited. Okay. In the books of A Limited, the relevant portion will have to be recorded. Now, what is going to be that relevant portion? Let's try to understand. See, in the JV, there are some assets. Okay. Now, those assets will get depreciated. Yes or no? Now, depreciation expense pertaining to those assets will be borne by whom? Of course, the venturers. Of course, the venturers, for which a particular ratio has also been decided. Yeah. So now, for this asset, or for all of these assets which will be recorded in the books of venturer, what do you need to do? You need to compute the depreciation. Okay. So you need to compute the depreciation. So now depreciation on land and building comes out to 20,000. Pipeline comes out to 3 lakh. Computers, 40,000. Vehicles, 60,000. Okay. Yeah. So now all in all, this expenditure becomes 4,20,000. Now you may be thinking, sir, how do we get this 20,000? So let's look at this one. Okay. So let's look at this one. So now amount of building which was constructed was 12 lakhs. Yes or no? 12 lakhs, on which depreciation of 60,000 was charged. Yes or no? Depreciation of 60,000 was charged. And then if you read this particular para, over here it was mentioned that the venturers decided to equally bear the total expenditure incurred on maintenance of pipeline. Yeah. Yeah. So now, one is the depreciation. So 60,000 contributed by each partner. So 20,000 will go to each partner. Now moving on to the next expenditure, which he will bear. That is going to be the maintenance of pipeline, 6 lakhs. Okay. Now for 6 lakhs, what do we have? 6 lakhs, 6 lakhs divided by 3. Okay, 6 lakhs divided by 3. Why it is divided by 3? Because it is equally contributed by the JV partners. So this will now move on to the P&L. This will now move on to the P&L. And whose P&L is this? This is the P&L of A Limited. So we are looking at the books of A Limited now. So in the books of A Limited, one is depreciation expense, second is maintenance of pipeline. Okay, so these two expenses have been recorded. Now, can we say that in the books of A Limited, only these two expenses will be coming? No, there are going to be various other expenses. Why? Because it's a company, it will be carrying out a lot of transactions. But for us, the information is limited to the JV which they have created. So that's why, what do you call it as? That's why you will call it as extract. Please remember, in the exam, you need to specify that this is an extract. This is not a full statement. Okay. Similarly, balance sheet extract. Similarly, this balance sheet extract will also be required to be prepared. And whose books are these? We are still on the books of A Limited. Okay, so we are looking at the books of A Limited. Please remember, we are not looking at the books of JV. We are looking at the books of A Limited, which is a venture. Okay, so that's why in this case, what do we have? In this case, once again, there are various assets. Okay, what are those assets? At one place, we have building. At one place, we have building, which has been depreciated. Then we have plant and machinery, which has been depreciated. Computers, depreciated. Vehicles, depreciated. Now, in case of building, in case of pipeline, in case of computers, in case of vehicles, we will not be picking up the full value. Please remember, we'll not be picking up the full value. We'll pick up only the share of A. Okay, only the share of A will be picked up. So if you look at these amounts, these are the shares of A. Yes or no? On which depreciation share of A has been charged. Yeah. So if you add these, what do you get? If you add these, what do you get? You get the amount of PPE. You get the amount of PPE, which will be recorded in the balance sheet of A Limited over here. Okay, so this is 23 lakhs 80,000. 23 lakhs 80,000. Yeah, everyone clear on this? Any questions, any doubts if you have, please let me know. Okay, so I can see one query coming from Unni Krishnan. He's asking, sir, how come depreciation is charged on land? No. See, please remember, it's the land and building. Over land, building is constructed. So that's why it's been called as land and building. Actually, it's a building. Okay, so this depreciation is charged on the building. Okay, yeah. Anyone else? Any more queries on this? Rashmi is asking, sir, all the venturers will make separate books. Same presentation will be followed in the exam? Yes. Now, in this example, we have looked at the books of only A. Similarly, you will also be required to prepare the books of B. Okay, same way. Depreciation you will charge, expenses you will charge, and balance sheet extract you will prepare for B. For B. Okay. Similarly, for C, you will do the same thing. In the books of C, you will have a P&L extract. You will have balance sheet extract. Okay. In fact, if you look at the requirement of the question also asked you for the same thing. Question also asked you for the same thing. Yeah. So these two will be prepared on the similar lines, which you should prepare on your own. Okay. Then Unikrishnan has a query. He is asking, consolidated P&L and the balance sheet includes each line item of JV contributed by the venturer? Yes. And that is what we have seen in case of this balance sheet. Okay. That is what we have seen in case of this balance sheet. Krishna is asking, a company having 5 JVs, each line of JV to be included in the consolidated financial statements. Yes, of course, each line will be picked up, but on a proportionate basis. Proportionate means the share of the venturer. For example, in this case, if you look at the JV, what is the amount of the assets? 71,40,000. Now, A, B, and C. A, B, and C, when they will pick up all of these assets. So what do? They will pick up their shares. They will pick up their proportionate share. They will not pick up the full amount. So if all of them will pick up the full amount, so that will be inappropriate. Okay, yeah. So that is something you need to remember. All right. Kiran is asking, sir, is there any MCQ also that may come in the exam? Yes, of course. All right. Any more questions on this? Any more doubts if you have? Quickly. Any questions, any doubts on this? Then we'll move on to our third type. Okay, third type means the third type of JV. So we have discussed 2 types of JVs so far. If you have any questions, any doubts, please let me know. Then we will move on to the third type. Yes, any questions? No? No questions, sure? Quickly, no questions? All right, so let's move on to the third type of JV. I can see this query coming from Preeti. Preeti is saying, sir, in merger. Okay, so I think, Preeti, I would request you to please park your query towards the end of the session. Otherwise, we'll digress from this topic. Yeah. So towards the end of today's session, you can just put down this query once again. Okay. Otherwise, we'll digress. Currently, if you have any questions around JV, that will be better. Okay, that will be better. All right. So now, moving on to third type of arrangement, which is called as jointly controlled entities. Jointly controlled entities. Now, in case of a jointly controlled entity, unlike what we had in case of JCO and JCA, a new entity is set up. Venturer creates a new entity. So you can say now a separate legal entity will come into the picture. A separate legal entity will come into the picture. And what will happen? All the venturers, they will pool their resources. Means they will bring in assets, they will bring in funds, and all of those resources will sit in this new entity, or you can say in this JV entity. Okay, and all of these resources which will be sitting in the JV entity, they will be shared by the respective JV partner in their ratios which are pre-agreed. In the ratios which are pre-agreed. So for example, say A, B, and C, they have set up a new company, ABC Limited. Now please remember, A Limited, B Limited, and C Limited, they will continue. So we are not saying that they are getting merged. It's not a merger. A Limited, B Limited, C Limited, they are only the investors, or you can say the owners. They have created a new JV company. So now in this JV company, they will contribute funds, they will contribute assets. And who will own these funds? Who will own these assets? It's this company. So owner of those will be whom? This company. And owner of this company will of course be these JV partners. Okay. Now, because all of these assets, all of these resources belong to this particular company, So that's why what will happen? This company will have to prepare its own books of accounts. Okay. So a jointly controlled entity maintains its own accounting records, prepares its own financial statements. It will prepare its own financial statements, unlike what you have seen in case of JCO and JCA. Okay, so this is going to be a separate type of structure wherein a separate legal entity is present. And moment we have a separate legal entity, what will that entity be required to do? That will have to prepare its books of accounts, that will have to have its separate set of financial statements. Okay, clear on this? Any questions, any doubts if you have on this? Okay, Kiran is saying yes, in this case, separate legal entity exists. So now what we will do is, once again, to discuss this jointly controlled entity, we'll pick up some examples. Okay, and through those examples, we'll try to get some more clarity around the structure. We'll also try to look at the accounting requirements of this type of structure as well. Okay, so I'll just move on to that question now. In the meantime, if you have any doubts, please let me know. Yes. A Limited, a UK-based company, entered into a JV with B Limited. Okay. Wherein B Limited will import goods manufactured by A Limited on account of JV and sell them in India. So now, if you look at this first part, okay, so if you look at this first part, in this first part, the objective, the purpose has been explained as to why they have come up. And please remember, whenever a JV will be created, so that's why, so every time there has to be some purpose. Only with some purpose that JV will have to come up. Otherwise, there will, if there is no purpose, then of course, no two investors, no two partners will come together and get into that JV. Okay. So now for us, what is going to be relevant? Now comes the information which is going to be relevant in terms of preparation of the books of accounts, preparation of the financial statements. A Limited and B Limited agreed to share expenses and revenues. Now they agreed to share expenses and revenues in the ratio of 5:4. In the ratio of 5:4 respectively. Whereas profits are distributed equally. Okay, so what they are saying is they have decided their ratios that for expenses and revenue it will be 5:4. When it comes to any profit which will be generated, that will be 50-50. Okay, now you may have a question. That's that there are two venturers. They are going to have a joint control. Okay, they are creating a separate legal entity. So how come for various items the sharing ratios are different? So that is possible. Okay, and that is why they will have a contractual arrangement. Yeah, so it is not necessary that each and every item will be shared in the equal ratio. That may vary. Okay, when it comes to profits, so profits will be distributed equally. Yeah. Okay. A Limited invested 49% of total capital, but has equal share in all the assets and is equally liable for all the liabilities of the joint venture. Now, we are given trial balance of JV at the end of first year. Okay, so trial balance of JV is given at the end of the first year. So information about expenses means P&L line items, then the balance sheet information. So I would say there are two parts to it. So this is about P&L and this is about balance sheet. Okay, then the information on the inventory is also available. You are required to prepare financials of this particular JV company. Financial statements of this JV. Okay. Now, before I move on to the solution, there are few queries. Let me just look at these queries. Okay, so now Uni Krishnan is asking, JCO, JCA, they are not having any separate legal entity. Then how do they do business without legal restriction as per the Companies Act? See, it's not necessary that for you to carry out a business, registrations under the Companies Act are mandatory. No. Okay, so there are various ways through which business may be conducted, wherein to create a separate legal entity in the form of a company is not necessary. Okay, so you can always have maybe a project or a venture which is unincorporated. Unincorporated means which is not incorporated as per the requirements of Companies Act. Okay, and you can just carry out those projects. So that is how it works, and practically also this happens quite a lot. Srinivasan is asking, sir, in case of liabilities and equities, what will be the treatment in all of these three cases that we have discussed? I'm assuming you are asking about the previous question, the previous question that we discussed. See, when it comes to liabilities and equities, all the liabilities which will be there, okay, they will always be allocated, you can say, in a way, to the respective venturer in their ratios which have been agreed. And I think you will get more clarity around it with the help of this example also. So let's go through this example. You will get more clarity. Why? Because even if in this example a separate legal entity is there, but the way these assets, liabilities, expenses will be picked up by each venture, that is going to be absolutely same. Okay, yeah, and we are going to discuss more examples. Okay, so I would say let's go through some of these examples that we are going to cover. You will get absolute clarity around some of these items. Okay, so now moving on to the balance sheet, or you can say the books of accounts in relation to this JV. Now this JV has got sales, yeah, amounting to what? 13,05,000. And this JV has got purchases, other expenses, and there is also an inventory in terms of its closing stock. Opening stock is not available, so we'll assume that to be zero, obviously. So change in stock will come in. Okay, so let's put down all of this information. Statement of P&L of the JV. Please remember, this is the P&L. This is the P&L of JV. Okay, this is the P&L of JV. All right, now let's move on to the balance sheet of the JV. So we are talking about balance sheet of JV. Please remember, we are not looking at balance sheet of respective venturer. No. So we are looking at the balance sheet of JV. Now in the balance sheet of JV, all of these line items, okay, all of these line items which are there in the trial balance will have to be picked up. They will have to be picked up. Yeah. So PPE, current assets, loans, liabilities, capital, and of course, closing stock of inventory, plus this profit or loss which has been generated. So that will also be moving in the form of reserves. Okay, so let's get on to the balance sheet. So now at the first place, what do? You will create a structure. You will create a structure, and then you will move on to the notes to accounts. So now in the notes to accounts, what do we have? At the first place, when we prepare this P&L, on the P&L, we will have our notes. Note number 1, 2, 3. So let's look at all of these notes one by one, because these notes are going to be more important. Let's understand why. Okay. See, revenue was 13,05,000. We have already discussed this. Revenue was 13 lakh 5,000. Okay. Now, when it comes to the JV, so JV will record entire amount of revenue because this has been earned by JV. This has been earned by JV. But when each venturer will pick up this amount, so now you will also be required to specify to whom does it belong? To whom does it belong to? So that's why what do you need to do? You will need to go back to the ratios that we have looked at. So revenue was agreed to be allocated amongst A and B in the ratio of 5:4. So that's why what is going to be the amount of A? Can you quickly compute and let me know? I'll also compute this. Okay, so now 13 lakh 5,000. 13 lakh 5,000 needs to be allocated amongst A and B. So divided by 9 into 5. So what do you get? 7 lakh 25,000. So now if you go to that P&L, 7 lakh 25,000. Okay. So this has been allocated in the ratio of 5:4. Correct? Yeah. So this information that you provide allocation, this is going to be the most important part. Why? Because in this information, you are demonstrating your knowledge of JV accounting. Okay, so if you just simply prepare the balance sheet P&L, that is going to be very easy. Okay, and you will not be able to demonstrate as to what is the element of JV in this case. Yeah, so that's why these elements of apportionment which you do, okay, which you can say is all about the portion which belongs to the JV partner is important. Okay, now same way, when it comes to expenses, again, they will be allocated in the ratio of 5:4. Okay, so 5:4. Yeah, so same way you will do this, right? Now, assets. So when it came to assets, so now there are going to be various assets. So we'll pick up all of those assets one by one. So at one place there was inventory that was decided to be shared on an equal basis. Assets were agreed to be shared on an equal basis. Now, if you remember the capital was specified that who will contribute the capital and in what ratio. So now if you just go back to the question, so question specified capital is 4,01,000. So if you are thinking where does this capital come from, it is there in the trial balance, number one. Now, when it came to this capital, please remember that capital was again having a different percentage. See, for expenses, revenues, there was 1%. What was that? 5:4. Profits, there was another percentage equally. For capital, it was specified 49% will be contributed by A, 51% by B. And assets, liabilities, they will be equal. They will be equally shared. So every time for each and every item, you need to be very, very careful. Okay, because there are a lot of ratios which have been agreed amongst the venturers. So that's why you need to be very, very careful in terms of allocating these amounts. Okay. So now what we will do is we'll just allocate these amounts. So capital is allocated in the ratio of 49:51. Okay. Reserves means profits equal 50-50. So these are equal 50-50, right? So now liabilities, what is the ratio? Can you tell me? Liabilities equal? Yeah. So liabilities, same ratio. Similarly, PP, same ratio. I'm not looking at the amount because all of these amounts are directly picked from the trial balance. So there's absolutely nothing to do in respect of that. So inventory 50-50, current assets 50-50. 50-50 means equal. And in the balance sheet of the JV, when you go, in the balance sheet of the JV, means the phase when you look at, all of these numbers will be placed. Yeah. Now, if you will prepare the balance sheet and the statement of P&L of the JV, okay, please remember, this is going to be a very, very simple exercise. So if you look at the P&L of JV, is that complicated? No, absolutely no. It's going to be a very, very simple item. So that's why please remember that in this particular question, what is going to be the most important part? This allocation. Okay. So all of these allocations that you demonstrate. Okay. So this component is what is most important. Clear? Clear on this? All right. So I can see some of the responses or queries. Okay. So Oni Krishna is asking, JCE, how is it different from subsidiaries? See, I'll come to that point. Okay, once I'm through with all these types of investments which are possible, I'll come to that. Okay, we'll just try to discuss as to how subsidiary is different from JV, how JV is different from associate, or how all of these are different from each other, and what all consolidation requirements are there. Okay, so let's get done with everything, and then I'll talk about it. Then I think Unni Krishnan has shared one response. He's saying in JCE, 50-50 JV standalone financial statements. Okay, so I think he has shared the computation. Then Unni Krishna is saying there is no uniformity in apportionment of expenses income, and even profit, how it will work in real world. No, so practically this is how it works. There's absolutely no problem. See, some of these things that you have been discussing, so practically if you'll go, you'll find some of these things happening the way you are reading it right now. Okay, so these are no different. That's why I'm saying you contractually all of these things are pre-agreed. They are pre-decided. They are always pre-decided. So they are always pre-agreed. Okay, so don't think that practically this is not how things will work. No. So this is how things can definitely work. Okay, practically this is how JV partners can decide their ratios, their allocations. So that is absolutely okay if they do this. Okay, we'll also be looking at one more question. But before that, if you have any more questions, any more doubts, please let me know. Okay, so now Srinivasan is asking, sir, nothing is mentioned for profit sharing. So we need to allocate profit in 40, 59, sorry, for 50, 49. No. So if you go back to the question, it was clearly written that profit will be equally shared. So if your query is that if the question is silent, you see, if the question is silent, then you should always assume that to be equal. And you should also give a note to this. Okay. So if the question is silent, then you should give a note. And you should always assume that that is going to be equally shared. Yeah, that is the best assumption I would say you should take. Always. Okay. Any more questions on this? Any more doubts if you have? Sangeetmani is asking, sir, as this question is consolidated, why should we apportion? See, Sangeetmani, in this question, okay, or let me just try to explain this point to you. Okay, so now, see, in this question, I'll just try to give you the context now why I'm just stressing upon this point of this allocation which has been demonstrated. See, in this question, a trial balance was given to you, correct? Yeah. And if you look at the trial balance, after that, there were no adjustments which were required. Okay, so if let's suppose you are required to prepare balance sheet, P&L using trial balance, okay, and that is going to be a question in the exam. So you should expect at least some complexity to be there so that you are tested at a certain level. So that is why you will have an examination. Yes or no? Yeah. So now if you look at that particular question, In that particular question, a very small trial balance is given to you. There are no adjustments which are required to be made. And if you just simply draw a balance sheet and the P&L using that trial balance, do you think you are getting tested at any level? Absolutely no. You are not getting tested at any level. Yeah. So does it mean that complexity has to be there always? No. So that's not what I'm trying to tell you. See, if you look at the requirement of the question, so that question is in respect of JV. Yeah. So that means that question wants to test your knowledge of AS27. Okay. So that question doesn't want to test your knowledge in relation to preparation of balance sheet and P&L. No. So that is not the objective. Okay. So in this question, objective is not to test your knowledge that whether you can prepare the balance sheet and P&L or not. No. So the question wants to test whether you understand the requirements of AS27 or not. Okay, so that's why if in the balance sheet, if in the P&L, you don't demonstrate that particular allocation, apportionment, which is there in respect of various JV partners, then all that information about the profit sharing ratio, about the ratio of assets, liabilities, about the ratios of expenses, do you think that is going to be relevant anymore? No. So that entire information will become irrelevant. Yes or no? Yeah, because otherwise, if you don't apportion, is that information going to get into any sort of complication? No. So is there any calculation which is required to be done? Otherwise, if you don't apportion, otherwise, if you don't allocate, no. So that's why this testing, okay, this demonstration of your knowledge in respect of AS27 is possible only when you put down that information in the solution which you provide. Understood? Okay. So now let's look at this particular question. A Limited entered into a JV with B Limited on 1:1 basis, means equal share. A new company C Limited was formed for the same purpose, and we are given the balance sheet of all the three companies. So A and B, can you tell me who are they? A and B in this example, what will you call them as? Over to you. In this example, what will you call them as? A and B. Over to you quickly. Quickly. Yes, everyone. How would you define A and B? Yes, very good. Kiran is saying venturers. Yeah, Pratima is saying venturers. Great. Rashmi is saying JVC. JV. See, when it comes to JV company, which company is the JV company? Which company is the JV company? Can you tell me? Which company is the JV company? Okay, Saurav has answered that A and B are the venturers. Very good. Sangeetvani has got the same answer. Which company is the JV company? Pratima is saying C Limited. Yes. So when it comes to JV company, that is C. Okay, that is C. So this is the JV company. So when it comes to JVC, which company is that? It's C, not A and B. A and B are the venturers. A and B are the venturers. Okay. I think Prerna has just joined. She's asking, what is it that we are covering? See, we are covering AS27 right now. Okay. All right. Saurav has answered this. Okay. So now in this particular question, we are given three balance sheets, A, B, and C. You are required to prepare the balance sheet of A and B under proportionate consolidation method. Now, let us try to discuss this proportionate consolidation method first, and then we'll prepare. Okay. Now, what do you mean by proportionate consolidation method? if you go back to our discussion that we had in case of holding and subsidiary company, okay, so if you go back to that holding and subsidiary wherein we had H limited and S limited, can you tell me what was the basis of consolidation that we had followed over there? Quickly, can you tell me what was the basis of consolidation that we had followed in case of subsidiary? Over to you, quickly. Can you tell me what was the basis of consolidation that we followed in case of holding and subsidiary? Quickly. Quickly, tell me. What was the basis of consolidation that we had followed in case of holding and subsidiary? Yes, quickly, everyone. Pooja is saying AS21. Rashmi is saying hold share greater than 51%. That is correct. See, the basis of consolidation was line by line addition. Yes or no? If you remember, whenever consolidated financial statements were prepared, what do? All the assets, all the liabilities of H limited are picked up. Remember, we discussed this. Or you think, no, sir, it's all gone. Yeah? Remember that? Yeah? So all of assets, liabilities of H limited and S limited were added together. They were added together. Yes or no? And when they were added together, what did you do? When they were added together, so say this was the consolidated CFS that you prepared. Yeah, wherein all of these line items were put down, from which we did some adjustments related to eliminations or other adjustments. Okay, basis which we got the final consolidated balance sheet or P&L, whatever be the case. Yeah, remember that? Now, when it comes to a JV, now in case of a JV, let's try to understand as to how the things are going to be slightly different. In case of a JV, say if there are two companies, A, B, and JV company, JVC. Assets and liabilities which will be there in the books of JV company. We understand all of these assets and liabilities belong to whom? They belong to whom? Can you tell me? All of these assets and liabilities which are there in the books of JV company, who do they belong to? Yes, tell me quickly. Rashmi is saying A and B. Yes, very good. So they belong to these two parties, A and B. And they belong to these two parties. Let's suppose on equal basis, means 50% belong to A, 50% belong to B. Yes or no? So that's why whenever it comes to preparation of consolidated financial statements, which A will prepare, please remember which A will prepare or which B will prepare. So what will they do? They will pick up 50% of these assets, liabilities, incomes or expenses and add to their assets, liabilities, incomes and expenses. Unlike what is done in case of subsidiary, wherein instead of 100, in case of a subsidiary, this 50% was actually 100%. And that is why we called it as line by line addition. In case of subsidiary, this 50% was actually 100%. But when it comes to JV, this 100% becomes 50% or maybe whatever percentage which has been decided between those two partners. Okay. So now this is the difference in terms of approach. This is the difference in terms of approach which is required to be followed when the consolidated financial statements of venturers will be prepared. Please remember, I'm not talking about financial statements of JVC. See, that is prepared. In the previous example, we discussed that. In the previous example, we discussed how do you prepare consolidated balance sheet, consolidated P&L of JVC. We have already discussed that. Now, once the consolidated balance sheet, consolidated P&L of JVC is prepared, yeah, how do you move those numbers to the consolidated financial statements of A is what we are going to look at in this example. Understood? Yeah. Unni Krishnan is saying, sir, it's not clear. No worries. So once we'll look at this solution, you will get clarity. Srinivasan is saying, sir, in this case, why the share capital of new company is not shared by both A and B? See, we have not solved this. So let's get done with this and then you will get the clarity. Okay. So let's get on to the solution first. I think you have already solved this. No worries. But let me just complete this. And once we'll complete this, you will get the clarity. Understood? So broadly, I've just explained you the approach which is required to be followed. This approach is called as proportionate consolidation method. Means you will consolidate on a proportionate basis. Now, what is going to be the proportion? That will vary. That will vary. So every time one will have to look at the proportion. Okay. So now, in this example, please remember, we are not preparing the financial statement of JVC. That is already prepared. We will be preparing the consolidated financial statements of A and B. So we'll pick up A first because the way A is prepared, same way B will also be. Okay. So we'll pick up A first. All right. So now, for A, when the CFS will be prepared, which two line items should we pick up? Can you tell me? For A, when the CFS will be prepared, which two line pick up? So we won 3 line items currently. 1, 2, and 3. So can you tell me which line items should we pick up for preparing consolidated financial statements of A? Over to you. Quickly, tell me. Which line items should be picked up? Should we pick up all 3? Should we pick up only 1? Or should we pick up only 2? Or you have some different thoughts around this? Okay, Rashmi is saying first one will be picked up. A, very good. Okay, so she is saying A will be picked up. But does it mean that only A will be picked up? Or some more line items will also have to be picked up? Tell me. Okay, so Unni Krishnan is saying, very good. Unni Krishnan is saying, sir, A will be picked up plus C will also be picked up on a proportionate basis. C will also be picked up on a proportionate basis. Okay, Kiran is also saying, no, B will not come. Why? Because B is a separate party and A has got nothing to do with B. Yeah. So now in this case, Nistala has answered, pick C and pick C on a proportionate basis. Very good. So now when C will be picked up, 50% of C belongs to whom? A. So when the consolidated balance sheet of A will be prepared, so what do you need to pick up? A plus 50% of C. A plus 50% of C. So that is going to be our approach. Okay. So now, for A, when we start off, please remember this share capital of C belongs to whom? Two parties, B and C. Correct? Yeah. So when you consolidate two parties, so what will happen? They will get knocked off. So if you pick up 50% of C, so share capital is what? 2,50,000. And in the books of A, there is an investment of 2,50,000. So these two will get knocked off. Yes or no? So that's why, do we need to pick up this 5 lakh? Yes. But that will get knocked off against the investment of A. All right. So that's why now when we'll pick up A and C, this share capital of C will be eliminated. So that's why now when we pick up all of these assets and liabilities plus the capital, we'll have to just remember that these two items are getting knocked off. Okay. So now let's move on to the balance sheet. Let's move on to the balance sheet. So now for A, share capital you can ignore. What is our note first? Reserve and surplus. Okay, so we'll pick up each and every item line by line. So now for A, reserves are 18 lakhs plus 50% of C, 6 lakhs. 6 lakhs. So on reserves, what do we have? 18 plus 6. 18 plus 6. Okay. A and 50% of C's reserves. So that is 6 lakhs. Done? Okay. Now, let's go back to the question. Loans, 3 lakh of A plus 50% of C means 1 lakh of C. So let's again go back there. So 3 lakhs of A plus 50% of C. 1 lakh. Correct? Similarly, all the assets, all the liabilities will have to be picked up. Srinivasan is asking, sir, in this question, nothing is mentioned about investment ratio. So why do you need the investment ratio? Okay, so they are saying that their ratio is 1:1. So 50%. So that will apply to each and everything. Okay. Now, if you look at current liabilities, so what is going to be the amount? 4 lakh plus 50% of C, 450. Yeah. So this is how you need to place each and every item in the balance sheet. Okay. Then once again, go back to the trial. Once again, go back to the balance sheet. Okay. So PPE, 30,50,000 plus 50% of 19,50,000. Similarly, current assets, 2 lakhs plus 50% of 50,000. So let's place these items also. Yeah, I'm just hoping you are now getting this point. It's a very, very simple. Okay, so 50%. Once again, 50% has been taken here. This is 2 lakhs plus 50% of 1 lakh. Okay, so now with this, what did we get? All the items which are required to be placed in the consolidated balance sheet of A. Please remember, standalone balance sheet of A is already available. Now we are looking at the consolidated balance sheet of A. So share capital will come as it is. Why? Because 10 lakhs plus 2,50,000. So 2,50,000 gets knocked off. Reserve and surplus from the notes. Non-current liabilities from the notes. Current liabilities from the notes will pick up. Okay. Assets. On the asset side, what do we have? PP from the notes. Current assets from the notes. There is one line item which we have not picked up. There is one line item which we have not picked up. Which item is that? Investment in JV. Now you may be thinking, sir, why didn't we pick up this investment in JV? So we have not moved this to the balance sheet of A. Can you tell me why did we not move this investment in JV to the consolidated balance sheet of A? Rashmi is saying very clear, sir, I am crystal clear. Okay, Sangeetmani is saying it's a very interesting chapter. Yes, of course. Consolidation is very interesting. Okay, so can you tell me why this investment in JV has not been picked up? Nistala is asking, sir, if no share basis is mentioned, you should take that as equal. Huh? Okay. Unni Krishnan is saying, sir, A Limited standalone balance sheet includes investment in C Limited. Yes. So Pooja is saying because this investment will get knocked off against the share capital. So it's a kind of elimination. Yeah. Very good. Rashmi is saying because it will get eliminated. Yeah. So that's why you will not pick this up. So that's why you will not pick this up. So what we have done is we have placed all of these items. Now, once all of these items have been picked up, what do you need to do? You need to just start praying that the totals of the balance sheet should match. Fortunately for us, in this example, these balance sheets have matched. Okay, Preeti is saying investment will not pick up. Why? Because this is adjusted against share capital. Nistala is saying because these are knocked off. So that's why you will not pick up. All right, clear on this? Everyone? Any questions so far? Any doubts if you have? Now, if you go back to the discussion that we had, now I am hoping that you would have got the clarity around this proportionate consolidation method. Yes or no? Quickly, please confirm. Yeah, everyone clear on this? Any questions around this? Any questions, any doubts? No? Any questions, any doubts if you have? Because then we'll move on to the associates. Okay. So now what we will do is we'll just pick up associates. Okay. And we'll try to now discuss the requirements of the associates. Okay. So I think Rashmi has a question. Rashmi is asking, sir, such type of questions will be expected in the exam. Yes, of course. Srinivasam is saying, I'm clear. Very good. So I think we can move on to our next topic, that is associates, which is all about AS23. But before we proceed on this, please confirm if you'd like to take a break here, maybe a short break, or should we continue? Quickly, please confirm, everyone. प्रीति is asking, sir, मैं क्लास में लेट आई हूँ, थोड़ा थोड़ा समझ आ रहा है. Very good. So anyways, we are going to discuss this AS23 now, which is going to start afresh. Okay, so I am hoping that this part should be clear to you, and the part which you have missed, you can just always go back and look at the recorded part. Okay, Pooja is saying no break. Rashmi is saying we should continue. Quickly, please confirm, should we continue or should we take a break? As always, everyone is saying let's not take a break, sir. Let's continue. Preeti is saying no break. Okay, so Unni Krishnan is asking, sir, how to identify in the question whether it's a subsidiary or the JV when the percentage is given as 80-20. And I'll come to this point. As I've told you that around some of the requirements related to JV, subsidiary, associates, okay, how do you differentiate? What are the accounting requirements? We'll just put down this in the form of a summary also, and we'll just talk about it. Okay, so I'll come to this point. Don't worry. Sangeetvani, I'll have to come back to your queries, okay, in relation to those particular illustrations, maybe towards the end of this session. So let's get done with what we have, in terms of what we need to understand. And then some of these specific illustrations that you want to discuss towards the end, we'll discuss that, okay? Sangeetmani is saying, let's not take a break. Let's continue. All right. So now we are moving on to the third type of structure. When I'm saying third type of structure, so it's about associates. Okay, so it's about associates. Means what is an associate? What are the requirements that we have in relation to associates? See, Let me just once again go back to the discussion that we had. Okay, and in fact, what I'll do is just give me a minute. I'll just pick up one working file. Prerna, I think you can just always go back and look at this recording. Huh? There's no quick reference of JVC that you need. So it's a separate full-blown topic. Okay. But it's all about AS27. Huh? Now, we are talking about associates. And before we really get on to the requirements of associates, let me just come back to holding and subsidiary once again. Okay, let me just come back to holding and subsidiary once again. Can you tell me how does an entity become a subsidiary? What was the criteria for calling an entity as a subsidiary? Quickly, everyone. Can you tell me what was the criteria for calling a company as a subsidiary? Under what situations an investee will be considered as a subsidiary? Over to you, quickly. When would you call a company as a subsidiary company? What is the criteria you will check for calling a company as a subsidiary company? Over to you. Yes, Preeti, we have started AS23 now. Okay, so I can see one response coming in. Pooja is saying when more than 50% shares are held and maybe the composition of board of directors is sort of, criteria that is required to be looked at. Okay. Then this response comes from Rashmi. She's saying in which there is a control greater than 50% shares are there. Composition of board of directors is also controlled. Kiran is saying if another company controls its boards, yeah, and of course 50% criteria is required to be looked at. Okay, then I can see similar sort of responses from Preeti, Unnikrishnan, Nistala, Sangeetvani, Srinivasan, Sumit. Great. So now let me just go back, okay, and get on to the requirements of holding and subsidiary company. So let's suppose if there was a company S Limited, say there was a company S Limited, okay, and for which we discussed, let's suppose there is a board of directors, and in the board of directors there are 5 directors. So in the board, how many directors do we have? 5 directors. Okay. 2, 3, 4, 5. Yeah. Now, if we say that H Limited has got 4 directors, means out of these 5 directors, 4 represent H, means 4 are the one who are from the side of H. Okay. Wherein we discussed that the power in respect of decision making means eventually if the decision is to be taken, then who will have that power? That power, if let's suppose lies with H, that is what we discussed as a situation wherein H gets control over S, which is also through more than 50% voting power. Yes or no? Now, in this case, Let's suppose H holds 75% shares of S. Okay. Let's suppose H holds 75% shares of S. Okay. And out of these four directors, four are represented by H. Okay. And let's suppose in this particular structure, there is another investor, say I Limited. There is another investor, I Limited, who holds 25% shares of S. Who holds 25% shares of S. And in this case, out of these five directors, one director belongs to I. Only one director belongs to I. Means representation of I on the board of directors of S is through one director only. So in this situation, do you think, now I have a question for you. In this situation, do you think I can have control over S Limited? Quickly, do you think I Limited can have control over S Limited in this example? Do you think the decision making will be driven by I Limited? Kiran is saying no. Rashmi is saying it's minority interest. Pooja is saying no. But Rashmi is saying yes. Saurav is saying no. Preeti is saying H will have control. Great. Okay, but see, whenever any decision will be taken, who will drive that decision making? Can you tell me? If any decision will have to be taken, who will drive that decision making? Okay, Kiran is saying H Limited. Rashmi is saying H Limited. Very good. Yes. So whenever any decision will be taken, ultimate decision making right, authority will always be with whom? It will always be with H Limited. But before the decision is taken, matter will be put across, that will be discussed amongst all the board of directors. Yeah. So if all the five directors are present, so definitely there were discussion. Yeah. Wherein this fifth director will also be discussing that matter. So we can say that majority will decide as to how the decision will be taken. And that's why decision making right will always lie with whom? That will always lie with H. There is no doubt about it. But amongst all of these directors, one director who will be sitting over there, okay, this fifth director who will be sitting over there, he will at least be able to participate in the decision making or not. So he cannot drive the decision making. He cannot be the ultimate authority who will decide what decision is to be taken. But can he participate or not? Tell me quickly, can he participate in the decision making or not? Rashmi is saying yes, he can participate. Pratima is saying yes, he can participate. Now, this right to participate in the decision making makes S Limited as the associate of I Limited. So in this example, what will happen? S Limited will be considered to be a subsidiary of H Limited. But for I Limited, S Limited will be considered as an associate. S Limited will be considered as an associate. So that's why when I Limited will prepare its consolidated financial statements. So I Limited will say that I Limited has an associate. Now, what is an associate? Associate means over which investor has got significant influence. Over which investor has got significant influence. And what do you mean by the significant influence? Significant influence means, this means power to participate in decision making. Please remember, this is only the power to participate. The moment we say that the investor has got power to participate in the decision making, what will happen? That will be considered to be a situation wherein investor has got significant influence over investee, and thereby investee, who is the investee? S Limited. Thereby investee will become associate of that particular investor. Everyone clear on this? Everyone clear on this? Preeti, you are clear on this? Yeah, quickly confirm. So this is the understanding of associate. What do you mean by an associate? How an associate is assessed? So the standard says, AS23 says that if the significant influence exists, then it will be considered to be an associate. And in case of greater than 20% voting power, it's presumed that significant influence will exist. Okay? Greater than 20% significant influence will exist. Okay? And any questions, any doubts if you have on this, please let me know. Then we'll get on to the accounting requirements in case of associates. Saurav is saying clear, sir. What about others? Quickly, any questions, any doubts if you have on the associates, on the understanding of associate? Sangeetwani is saying associate will be I Limited or S Limited. Can tell me who is the investor? Who is the investor? Who is the investee? It's the investee who will be the associate. So he is going to be the associate. S Limited. S Limited will be the associate of I Limited. Okay. S Limited will be the associate of I Limited. Rashmi is asking, sir, if S Limited is called as I Limited associate, then what do you call I Limited as? I Limited is the investor. I Limited you can call as the investor who has made the investment in S Limited. Okay. Nistala is clear on this. Unni Krishna is also clear. Okay, great. Very good. So now, in respect of associates, now at one place, what do we have? At one place, we have I Limited and we have S Limited. S Limited is an associate. Okay. Now, I Limited will be required to prepare standalone financial statements. Yes or no? I Limited will be required to prepare standalone financial statements. Similarly, S Limited will also be required to prepare standalone financial statements. So both of them will prepare standalone financial statements. Why? Because they are companies. They are separate legal entities. So that's why both of them will prepare standalone financial statements. Okay. But over and above standalone financial statements, I Limited will also be required to prepare consolidated financial statements. And in the consolidated financial statements, now what will happen? I Limited will have to consolidate S Limited. Similar to what we had done in case of subsidiary, similar to what we had done in case of JV. Okay, so I Limited will have to consolidate S Limited. S Limited in consolidated financial statements while preparing consolidated financial statements. Okay, so now when I Limited will prepare consolidated financial statements, if it would have been a case of a subsidiary, if it would have been a case of a subsidiary, then we discussed consolidation is done by line addition. If it's a case of JV, then we discussed consolidation is done by proportionate consolidation method. But if it's a case of associate, then another method will come into the picture, which is called as equity method. Another method will come into the picture, which is called as equity method. Means whenever consolidated financial statements will be prepared, so you can always note this down as a summary. For subsidiary, what do we follow? Line by line addition. We discussed that under AS21. Okay, so this we discussed under AS21. For JV, we follow proportionate consolidation. So this again we discussed under AS27. And for associates, what do we follow? Equity method, which is covered under AS23. Now comes the question that what is equity method? How the consolidation will be done using equity method. Yeah. So now, for getting onto this equity method, we will pick up some questions through which we'll get clarity as around the equity method, how the equity method is required to be looked at, what will become the basis for consolidation under equity method of accounting. Okay. So now let me just pick up one question, and through this question, we'll just try to get some clarity around the equity method. All right, so let's look at this question. See, through this question, we'll just be trying to understand around the equity method. Okay. And then we'll also be discussing the consolidation requirement using equity method. Okay. So we are going to unfold all of these requirements step by step. Yeah. I would say out of all the consolidation methods that we have discussed, as you move from AS21 to AS23, things become simpler. When it was line by line addition, there were a lot of requirements in relation to computation of goodwill, capital reserve, a lot of adjustments related to elimination, line by line addition, minority interest. When it came to proportionate consolidation, it became very simple. Why? Because only the relevant portion you will pick up, proportionate basis. Now, when it comes to equity method, this you will find is even simpler. Yeah. So let's understand this. A Limited acquires 45% of B Limited. A Limited acquires 45% of B Limited on 1st of April 2000 X1. And for this acquisition, A Limited paid 15 lakhs. So can you tell me what do you call this 15 lakhs as? Over to you. What do you call this 15 lakhs as? Quickly. Quickly, everyone. When a price is paid by A Limited to acquire 45% shares of B Limited, what do you call that price as? Rashmi Singh investment. Okay. Any other terminology which you remember is used for such investment? Investment is correct. Any other terminology that you remember is used for such investment? Pooja is saying investment cost of investment. That is again correct. Any other term? Pratima is saying purchase consideration. Yes. Very good. So this is the purchase consideration. And I think same is the response from Sangeetvani, Nistala, Srinivasan, Sumit. Very good. Okay. So now there is a purchase consideration of 15 lakhs. Okay. Then we are given the balance sheet abstract of B Limited on 1st April X1. Means on the date when 45% shares of B were acquired, their balance sheet extracts are given. Capital, security premium, reserves. Then it says B Limited has reported net profits of 3 lakhs and paid dividend of 1 lakh for the year ended 31st March X1. So what does it mean? That on 1st April X1, okay, so all these items were there. Now during this year, B Limited has made a profit. Okay, so this is 31st March 2000 X2. Now during this year, B Limited has made a profit of 3 lakhs. Okay, and has also paid a dividend during the year, also paid a dividend amounting to 1 lakh. So that means this dividend is paid out of current year's profits only. You are required to calculate the amount at which investment in B Limited should be shown in the consolidated balance sheet of A Limited. Now, please remember, they are asking about consolidated balance sheet of A Limited. And that is as on 31st March X2. This is not required on the date of acquisition. What is the date of acquisition? This is the date of acquisition. On this date, balance sheet is not required. In fact, only a portion of balance sheet of A Limited is required on this particular date. Okay. Now, in this case, before we move on to the solution, there are few things you need to remember. Yeah, which are important. One, we are not required to prepare standalone balance sheet of A or B. We are only required to look at consolidated balance sheet of A. Yes or no? Yeah. And for consolidated balance sheet of A, there will be two line items. One that of A and other one is that of B. One that of A and other one will be that of B. Now the line items of B will be picked up using equity method, because now 100% line by line addition you will not do, proportionate consolidation you will not do. So what will you do? You will use equity method of accounting. Okay. And while using equity method of accounting, question is again not asking you about complete balance sheet, means complete consolidated balance sheet. It is only asking about investment which A will show in its consolidated balance sheet in B. So let's try to work out this part only. Work out this part only. Now, before we move on to the solution, let's try to understand the meaning of equity. Now, what do you mean by equity? Equity means net assets. What do you mean by equity? Net assets. Please don't get confused. Equity share capital, I'm not saying is not equity. Equity share capital will have the same meaning as you understand. I'm saying for the purposes of equity method of accounting. What do you mean? It means net assets. It means net assets. So for example, if on 1st of April 2000 X1, if one has to check net assets of B Limited, what will those be? These are the net assets of B. On 1st April X1, what are the net assets of B? Capital plus reserves, all the reserves, correct? Now, after 1st April, if one has to check what are the net assets of B on 31st of March X2, so how can you compute that? Very simple. To this balance, which was there on this particular date, if you add the amount of profits and deduct the dividends which have been distributed out of profits, what do you get? Closing balance of net assets. Closing balance of net assets. Equity method of accounting means that the investor, can you tell me who is the investor here? Can you tell me who is the investor here? Over to you quickly. Who is the investor in this example? Rashmi is saying A Limited. Pooja is saying A Limited. Very good. So equity method of accounting means that the investor will pick up only the proportionate share of net assets, period on period. That the investor will pick up the proportionate share of net assets year on year. So let's try to understand as to how that will be computed. Okay. So now at the first place, at the beginning of the year, means at the date of acquisition, we have purchase consideration amounting to 15 lakhs. From the purchase consideration, if you reduce net assets, so what is the amount of net assets? 16 lakhs. 45% of 16 lakhs, what do you get? 7,20,000. Now, from the purchase consideration, if you reduce net assets, what do you get? Goodwill or capital reserve. Remember this discussion that we had under AS21. Same working you will have to do here. Same working you will be required to do over here as well. Okay. So now in this case, at the time of acquisition, please remember, at the time of acquisition means 1st April 2000 X1. What do you get? Goodwill. Now you may be thinking, sir, same sort of exercise is required. Yes. Same working, very simple. So we'll calculate the amount of goodwill on the date of acquisition. Okay. So now, on the date of acquisition, you will have to just simply break. You will have to just simply break this investment. Now, this is the amount of investment, yes or no? Now, this is the amount of investment which you have in B Limited. So this amount of investment is required to be broken into two parts. So this purchase consideration will be broken into two parts. One will be goodwill. Now this amount of 15 lakhs has been paid towards two items. One was paid towards net assets. So we'll say share of net assets 7,20,000 and remaining 7,80,000 has been paid over and above net assets. So what did you call it as? Goodwill. So every time you will present it under equity method in the consolidated balance sheet, what do you call it as? You will have to split this. into two parts. You will have to split this into two parts. So what will you call it as? You will have to call it as 7,20,000 as share of net assets. Add goodwill 7,80,000. So the total that you get is what? 15 lakhs. Okay. Now this is what you had on 1st April 2000 X1. To this, what do you need to do? Now, if you have to reach to the end of the year, if you have to reach towards 31st March X2, to the net assets, what do you need to do? Add any additions to the net assets. Now, what have been the additions to the net assets? Profits on a proportionate basis and deletions, means dividends on a proportionate basis. So this you will add, this you will deduct. So what do you get? Carrying amount of investment at the end of the year, 15,90,000. 15,90,000. Clear on this, everyone? So this is how it will be presented as at the year end. Sangeetmani is asking, sir, if there is capital reserve, how do you present it? So we'll discuss that. Okay. So we have got one more example. In that example, we'll discuss that. How do you present it? Don't worry. Clear? Okay. So Kiran is asking, why is dividend deducted? See, dividend is deducted because when B will pay dividend, okay, so that will reduce the amount of net assets. Yeah. And in this case, what is it that you are trying to show? You are trying to move from opening balance of net assets, which was 15 lakhs, to the closing balance of net assets. Okay, so this was on 1st April 2000 X1, and this is what you have on 31st March 2000 X2. Clear? So that is why you will do this. Clear, Kiran? Kiran is saying, but investment is made by A Limited. Yes, investment is made by A Limited. So that's why you are showing this in the books of A Limited only. So this is not being shown in the books of B Limited. Please remember, it's the consolidated balance sheet of A Limited. Okay. Kiran, it's the consolidated balance sheet of A Limited. This is what you call as equity method of accounting. Clear? Any questions on this? So we'll pick up one more example. We'll pick up one more example through which you should get some more clarity. So let me just move on to the next example. Just give me a minute now. All right, so let's look at this example. Preeti is asking, sir, why do we calculate carrying amount of investment? Because this investment which A has done in respect of B is required to be shown in the consolidated balance sheet under equity method of accounting. Okay, so that is what equity method of accounting requires. Srinivasan is asking, sir, cost of investment is post acquisition. No, the cost of investment is on the date of acquisition. It is not post acquisition. Then why profit or dividend is added? See, you have cost of investment one on the date of acquisition. Then how is that changing period on period? That is what you are required to demonstrate. Okay. This is what you are required to demonstrate. And I think in this example, we are going to continue in terms of our discussion, in terms of our presentation. So hopefully you should get some more clarity as around things that we have discussed. Okay. But before we move on to this example, any more questions, any more doubts, if you have, please let me know. Yes. Any more questions, any more doubts, if you have, quickly, please let me know. Over to you. Any more questions, any more doubts? Everyone, please confirm. Any questions, any doubts? No? Okay, so Kiran has a question. Kiran is saying this is a consolidated balance sheet of A and B. Yes. So that was the consolidated balance sheet of A and B. Okay. So Arav is saying, sir, let's move on to the next point. Okay. So I think Unni Krishna is getting clarity on this. Great. So now moving on to this illustration number 2. A Limited acquired 40% shares in B Limited on 1st April 2000 X1 for rupees 10 lakhs. So let me just once again put down this information over here. Just a minute. So on 1st of April X1, A Limited acquired 40% shares of B Limited. So 40% shares have been acquired. Okay. And 10 lakhs have been paid for that acquisition. On that date, means on this particular date, B Limited had 1 lakh equity shares of rupees 10 each, fully paid, accumulated profits of rupees 2 lakhs. Okay, now before I move further, can you tell me the amount of net assets of B Limited on 1st April X1? Over to you. Can you tell me the amount of net assets of B Limited on 1st April X1 before I move further? Quickly, everyone. Quickly, amount of net assets of B Limited. Please remember, I am asking you the amount of net assets of B Limited on 1st April X1. Pooja is saying 3 lakhs. What about others? What about others? I'm just simply asking you the amount of net assets of B Limited on 1st April X1. I'm just hoping everyone is with me. Yes, Rashmi is saying 12 lakhs. What about others? Kiran is saying 12 lakhs. Harish is saying 12 lakhs. Preeti is saying 3 lakhs. What about others? See, on 1st April X1, what is the share capital of B? 10 lakhs. Is it 1 lakh? No. 1 lakh is the number of equity shares of rupees 10 each. Now, this is the mistake which you will make in the exam also. So that's why you have to be very, very careful. Okay. So 10 lakhs plus 2 lakh. So what is the amount of net assets? So net assets on this date are 12 lakhs. Clear? Clear? Okay. Now, during the year X1, X2, during the year X1, X2, B Limited suffered a loss of 10 lakhs. So there is a loss of 10 lakhs. Okay. Then it says during the year X2, X3, there is again a loss of 5 lakhs. Then during the year X3, X4, there is again a loss of, sorry, this is X2, X3, there is a loss of 12.5 lakhs. Sorry, this is 12.5. Let me just change this. This is 12.5. Okay, and X3, X4, there is a loss of 5 lakhs. Yeah. So now, you are required to show the extract of consolidated balance sheet of A Limited on all the 4 dates. All the 4 dates means 31st March X2, 1st March X3, 1st March X4, and of course 1st April X1. Before we get on to the solution, can you just only give me, okay, I need only one thing from you. Okay, just give me a minute. So this is 31st March 2000 X2. This is 31st March 2000 X3. And this is 31st March 2000 X4. Now, can you please let me know the amount of net assets of B Limited on 3 dates? See, for 1st April X1, you have already told me. What is going to be the amount of net assets of B Limited on these 3 dates? 31st March X2, X3, X4. Over to you. Quickly, let me know the amount of net assets on these 3 dates. Over to you, quickly. Let me know the amount of net assets of B Limited on these 3 dates. 31st March X2, 31st March X3, 31st March X4. Yes, quickly. What is going to be the amount of net assets of B Limited on these 3 dates? Okay, Kiran is saying on 1st April, okay, sorry, first it is 2 lakhs, 31st March X2 2 lakhs, same is the response from Pooja. Okay, so let me just also note this down. So this is 2 lakhs. Okay, what about others? What about 31st March X3? What is 31st March X4? Sangeetpani is saying 4,80,000. What about others? Quickly. Sangeetpani, please listen to my question carefully. I am asking you the amount of net assets of B Limited on 31st March X2, 31st March X3, 31st March X4. I'm not asking you for the share. I'm asking about the net assets of B Limited on these 3 dates. Net assets of B Limited on these 3 dates. Let me just see what more responses. Okay, Rashmi has solved for all these 3 years. Rashmi is saying, no. So I think you are talking about profits or losses. I am looking at only the net assets amount. Yeah, so you're saying loss 10 lakh 50. See, losses are given in the question. Profits and losses are given in the question. So if you are commenting on profits and losses, that is not required. That is given in the question. Preeti is saying 2 lakhs on 31st March X2. Then I think 5 lakhs. Then I think 7 lakhs. Okay, Harish is saying 10.5 lakh. Okay, Harish is saying 31st March X2, it's 10 lakhs. 31st March X3, negative 10.5. Negative 10.5. And on 31st March X4, negative 15.5. Very good. Now, please understand before we get on to the solution. See, till the time you will not understand this net asset of associate, you will not be able to understand the consolidation requirement. Okay, and I need your attention. This is very simple, but I need your attention. You need to understand this carefully. On 1st April, what was the amount of net assets? 12 lakh. Now, during the year, if there is a loss of 10 lakhs, during the year, if there is a loss of 10 lakhs, what will happen? These net assets will fall down to 2 lakhs. These net assets will fall down to 2 lakhs. Yes or no? Then next year again, if there is a loss of 12.5 lakhs, what will happen? These net assets will become negative. These net assets will become negative. They will fall down to minus 10.5. And then next year again, if there is a loss, so what will happen? These net assets will again fall down to negative 15.5. Negative 15.5. Okay. Yeah. So balances of net assets. Are you clear on those balances? Everyone quickly please confirm. Are you clear on the balances of net assets? Yeah. Kiran is saying clear. Rashmi is saying I wrote losses against net assets. Same mistake you can do in the exam. That is what you need to remember. Sayanto is clear. Okay, great. So let's get on to the solution now. Because if you have understood these balances of net assets, then I think its solution will become very, very easy for you to understand. Now, first, we will start with 1st April X1. Now, on 1st April X1, what do we have? Net assets of 12 lakh. Okay. Yeah. And the proportionate share on these net assets is what? 4,80,000. Yeah. What was the amount which was invested? 10 lakh. 10 lakh was the amount invested. So you can say goodwill is 5,20,000. Now, how will the investor present this in the consolidated balance sheet? So we discussed that this cost of investment will have to be broken into two parts. This will have to be broken into two parts. How do you break it? One portion which is going towards net assets, 480, and the other portion which is going towards goodwill, 520. This is 520, so 10 lakhs. So on 1st April X1, this is how you will present it in the consolidated balance sheet. In the consolidated balance sheet. Now, as we move further to 31st March X2, what will happen? This cost of investment, is what we will pick up and we will start with this. So you will just replicate this number over here on 1st April. You will replicate this number over here, 5,20,000, 10 lakhs. Now from this 10 lakhs, proportionate share of loss will be reduced. So in the first year means X1, X2, there was a loss of 10 lakhs. So 4 lakh loss will be apportioned over here. So what is going to be the carrying amount of investment? See, at the beginning, the carrying amount of investment was 10 lakhs. And you presented it by showing this split. So this was the split. Total amount was 10 lakhs only. Total amount was 10 lakhs only. Yeah. So now this carrying amount of investment has gone down. Why? Because a loss of share has come in. So if there will be a loss of share, carrying amount will go down. Carrying amount will go down. So now the carrying amount of investment on 31st March X2 is what? Only 6 lakhs. Only 6 lakhs. From 10 lakhs, it has gone down to 6 lakhs. It has got reduced. And what is the reason for the reduction? What is the reason for the reduction? Loss. The reason for the reduction is loss. Okay. So now on 31st March X2, how do you present this in the consolidated balance sheet? Again, very simple. A portion which is towards the net assets, that will remain intact, 4,80,000. Okay. On this portion of 4,80,000, you will apportion the loss of 4 lakh. So what will happen? This portion of 480 will go down to 80. Portion of goodwill remain as it is. Portion of goodwill remains as it is, unchanged. So that's why share of net assets becomes 80,000. So this was 480 earlier. This was 480 earlier. So from 480, it becomes 80. And goodwill share remains as it is, 520. So all in all, what is the amount of investment? 6 lakhs. And this has to be 6 lakhs. Why? Because this is what we computed over here. So this is just required to be demonstrated like this. Okay. So now we are on 31st March X2. We are on 31st March X2. Let's move on to the next year. Now, what do? You start with 31st March X2, 6 lakhs. Now, in the next year, once again, there is a loss, 12,50,000. And the share of loss is what? 5 lakh. So this again, you will allocate over here. Now, the carrying amount of investment will go down to 1 lakh. Carrying amount of investment will reduce to 1 lakh. From 6 lakhs, it will reduce to 1 lakh. So that's why, what is it that you will do now? Now, the share of net assets that you had at the beginning was 480. 480. From this 480, there was a loss in the first year of 4 lakh, which you have apportioned. Loss of 5 lakh, which you have apportioned. So that's why 480 minus 9, what does it become? 480 minus 9, what does it become? 480 minus 9, what does it become? Tell me, 480 minus 9, what does it become? 420. Correct? 420. Yeah. To this, what do you add? Amount of goodwill. Now, what was the amount of goodwill? 5,20,000. This was the amount of goodwill which you had. So this you will add here. 5,20,000. So 520 less 420. So now what is the amount of investment? 1 lakh. So on 31st March X2, this is 1 lakh. This is 1 lakh. And this has been presented like this. This has been presented like this. Okay. Yeah. Clear? All right. Now, moving on to the next year. Next year, again, there is a loss. Next year, again, there is a loss. So you start with the opening balance of 1 lakh. And now the loss share is what? 5 lakh into 40%. It's 2 lakh. Now comes the very important point. Standard says that to the investor, you will apportion the share of loss only to the extent of the carrying amount of investment that the investor will have. I'm repeating this point. Share of loss, apportionment to the investor will be limited to the amount of the carrying amount of investment. So now in this case, what should have been the amount of loss which should have been apportioned? 2 lakhs. But actually, is this amount apportioned? No. Actually, this much amount has not been apportioned. This has been capped to 1 lakh. This has been capped to 1 lakh. Thereby, the investment balance has become 0. This has become 0. Now, in the third year, even though the loss share is 2 lakh, investor will pick up only the share of loss to the extent of 1 lakh. Why? Because his investment is left to the extent of only 1 lakh. Only to the extent of 1 lakh. So that's why in the balance sheet, on 31st March X4, what will happen? Will show investment in balance sheet is nil. Please remember, we are not making it negative 1 lakh. This will be restricted. Okay, this will be restricted. Clear? Clear on this? Any questions on this? Any doubts? If you have, please let me know. Rashmi Singh said, please explain 4,20,000 again. Sure. So let me just go back to this year. Okay. Now, Rashmi, in this case, if you remember, this was the opening balance. 4,80,000, you remember? This was the opening balance on 1st April X month. Correct? Yeah. Are you with me up to this? Yeah. Maybe Mr. Ajit, you can just open this window for the student to ask questions. Huh? Okay. So now, when it comes to the share of losses, now in the first year, the share of loss was 10 lakh. In the second year, there was a share of loss 12,50,000. Sorry, 10 lakh and 12,50,000. Okay. Now, share of loss in the first year out of 10 lakh was 4 lakh. Share of loss in respect of 12,50,000 was 5 lakh. Okay. So that's why from 480, what do you reduce? 9 lakh of loss. From 4.8, you will reduce 9. So what do you get? 4.2 negative. 4.2 negative. Clear? Inistala is clear on this. Everyone clear? Everyone clear? Any questions, any doubts if you have on this? Quickly. Anyone? Any more questions? Any more doubts if you have?
सर मुझे डाउट था ये जो इलस्ट्रेशन नंबर 1 है उसके अंदर डिविडेंड दिया हुआ है वो ड्यूरिंग द ईयर का दिया हुआ है तो मतलब पेड तो वो प्रीवियस ईयर का हुआ तो उसमें प्री एक्विजिशन डिविडेंड नहीं आना चाहिए था सर इलस्ट्रेशन 1 में।
देखो इलस्ट्रेशन 1 में जब आप जाते हो उस डिविडेंड को आप जब देखते हो, ओके, सो हमारा वहां पे ऑब्जेक्टिव क्या है? सो वी आर लुकिंग एट द नेट एसेट्स. Okay, so we need to go by the objective that we have. So our net assets as an opening balance, we need to understand wo kya hai. So let's suppose whatever is the number, I don't remember the number, and then our objective is to reach up to the balance of net assets as at the end of the year. Okay, so that's the objective. I'll come to your query also. Now let's suppose if this net asset as an opening balance was 100. Okay. Now during the year, if let's suppose there is a profit of 10, so can you tell me what is going to be the closing balance of net assets? Quickly.
110.
110. Okay. 110. 110. Now, out of this 10, if let's suppose this entity distributes a dividend of 2, so can you tell me what will be the closing balance of net assets?
108.
108. Okay. So that means you are clear at least on this point that how the balance of net assets will change. Now, coming back to your query. See, if during the year a profit of rupees 10 has been made and a dividend has been paid out of these profits of rupees 10. So whenever dividend is given, what do you assume? You will first of all assume that this has been paid out of the current year's profits. Always. Okay. So that is the first assumption you should draw. You should not be thinking that dividend will be given out of the reserves of the opening balance. No. You should always assume that dividend is given out of the profits of the current year. So that is why that treatment has been given, wherein the net assets balance has been cut down because of the dividend amount which has been paid during the year. Understood?
यस सर, लेकिन सर जैसे ये 2 रुपए जो डिविडेंड दिया गया है ये तो प्रीवियस ईयर का होगा ना, मतलब पे इस साल किया गया लेकिन होगा प्रीवियस ईयर का तो
not necessarily. See, till the time that information is not available, I can understand your query as to where you are coming from. I think you are just trying to correlate this to the proposed dividend. Okay, where you may be thinking that this has to be for the previous year. So dividends could be of 2 types, one for the year and one is interim dividend. So in the question you don't know. Okay, so question says dividend paid during the year. So it could be interim dividend which has been paid out of the current year's profits and which has also been paid during the year. Understood? Clear on this? All right. So I think with this, we can just conclude our discussion. Let me just quickly summarize my points. And in respect of subsidiary, JV, and associate. As I told you, once we are done, we'll just try to discuss the differences also, though I have just put down in the form of summary also. See, when it comes to subsidiary, the investor has unilateral control over there. That's why investor will do line by line consolidation. When it comes to JV, investor will never be one. It has to be more than one always. Whatever be the type of JV, it has to be more than one. And in that case, which method of consolidation will be followed? Proportionate consolidation. When it comes to associate, there can be one investor, of course. Yeah. But that investor will not be following line by line consolidation method, and neither line by line consolidation nor proportionate consolidation. So which method will be followed by the investor? Equity method of accounting. And in case of equity method of accounting, you just need to simply understand that he will pick up the portion of equity. Okay, he will pick up the portion of equity. What is equity? Under equity method of accounting, net assets means the investor will pick up the portion of net assets. Okay, so that is how these three are required to be differentiated. So that is how you need to pick up these things always. And before I conclude my discussion for today, I would suggest everyone to practice questions around this. See, consolidation is a very important topic. So that's why you should just make sure that whatever you have discussed, you revise this and ensure that all of these questions, whether those that we have solved or maybe other ones that you have been looking at in various books that you are accessing, okay, you practice all of these questions. All right. So with this, I would just conclude this session. Thanks once again, everyone, for your time and for your wonderful participation throughout the session. Thanks so much.
Thank you, sir.
Thank you.